question arises quite frequently as to when is the right time to acquire a distressed asset, especially because we've been in a period of 3 or 4 years when have been lots of distressed assets that have been for sale. So is now the right time to actually acquire them or not? We believe, and based on some of the research that we've done at the M&A Research Center at Cass Business School, that now is a very good time, mainly because of a number of factors that are poised to bring back the M&A market. And the research actually shows that you want to be acquiring a distressed asset when the market is just starting to come back, not when it's peaked, or certainly not when it's on a downturn. There are a number of advantages to buying a distressed company. Obviously, the most important one is the fact that you get an asset at a distressed price if you're buying a distressed company. So the price might be quite good compared to what you would have had to pay if that company was healthy. You can acquire these companies quite quickly. Once they are entering into distress, there's a great motivation on the part of the sellers that they want to get it sold before it goes from distress into insolvency or bankruptcy. So speed is an issue that comes to play here. It's also very, very clear when you're buying a distressed asset that the company is distressed. The people in that company know they're in distress. They're willing, therefore, to make change. It's therefore, in many cases, a lot easier to rapidly integrate that distressed company into the healthy company that's buying it. If you decide to acquire a distressed business, there's really 5 key, very important actions that I think one should take. First one is speed. That is, you have to act very quickly. You have to make sure that you get that asset before it actually has turned into an asset which is bankrupt or insolvent. Makes it much, much more difficult if you haven't acted quickly. This is before the deal degenerates. Secondly, you need to do deep due diligence. What do I mean by deep due diligence? In this case, it's digging beyond what you would normally be looking at in due diligence, because you have to find what the causes were of the distress, why the company is in this, and it may not be exactly what is publicly known about that company. So you really want to find out, is it the people, is it the products, is it their process and what they're doing? This is actually digging much further than you would normally do. Third is you need to integrate the company very quickly once you have it. So again, it's an issue of speed, but in this case it's integration and making sure that the assets don't, number one, degenerate further, that people don't leave, but that you very, very quickly act in order to be able to get the greatest value that you can out of something which is obviously in distress. Fourthly, you need to identify the poor performers in that organization. The one that you're buying the distressed asset. This could be individuals, it could be a division or part of the company that you would want to spin out or separate from the healthy part. It's basically excising or amputating the bad away from the good to make sure that the good is in fact not affected by the bad. And lastly, and perhaps most importantly, stick to your knitting. Stick to what you in fact know best. There's quite a bit of research out there, some that we've done at Cass Business School in the M&A Research Center, which looks at when companies were most successful in acquiring distressed assets. They were most successful when they stuck to their knitting, when they bought a company which was in the same country, so therefore not going cross-border, and secondly, in the same industry, an industry that they know well. That, of course, feeds back into having an ability to be able to integrate it quickly, to be able to act quickly in terms of getting the deal done and doing the due diligence, because they'll know what to look for. In thinking about how long the window of opportunity is going to be open for acquiring distressed assets, there's a fair amount of uncertainty on that one. When is the market going to come back? If you'd asked me that question 2 years ago, I probably would have said in 6 months. You ask me that today, I probably would say the right opportunity is within 6 months. Hopefully, that's not a rolling 6 months, and that the market truly will come back. There certainly are a lot of reasons why the market should be poised to come back relatively quickly. But first, we have to get confidence. We have to get confidence in boardrooms. CEOs have to be confident. And what will build that confidence is probably an equity market which is relatively flat or perhaps a little bit up. But then for the M&A market to come back, we're really going to need to have that sort of trigger event, the catalyst deal, a big deal that's a headline deal, but not one that's actually been in the industries where there have been a lot of deals. So not in the oil and gas industry where we've seen a lot of deals, not in the metals and mining area, not in pharmaceuticals and healthcare, but something in another sector, industrials perhaps, high tech, maybe even consumer products.